Hey everybody, welcome to the show. Today is going to be a solo episode and going to talk a little bit about the tax benefits of syndications and a bit about my story of how I saved six figures in taxes last year in 2021 just by utilizing some of these strategies. So a bit about me, how I really started diving into the tax benefits of syndications was because I was living and working in New York City. I was a partner in a prominent non-performing and reperforming mortgage fund, and things were going really well, at least financially, and I was paying 50% tax on my income at that bracket. So I was looking into ways to generate more tax efficient income. And I did have an IRA, and I know there's things you can do with self-managed IRAs, but I had not built up a significant IRA income, and I also needed to compound my actual standard investment income that wasn't in an IRA. So I stumbled across multifamily syndications, and I started investing passively. And syndications are, for high income earning people, much more efficient than REITs. We get this question a lot. The thing about REITs is that tax structure is not taxed at the entity level. So when it passes through a dividend, the dividend is taxed at the individual level. And unlike owning, say, Apple stock, which is a qualified dividend, majority of REITs are not qualified dividends. So you actually end up paying 29% tax on those dividends. So still maybe better than 50% if you're in New York or California, but it's still not the most efficient strategy. Add to that, you have issues of just market volatility. As we record this, the market had a really rough week the last few weeks, and many REITs are down 15-20% along with the broader market. So to talk a little bit more about what my strategy was and why we employ syndications both through our fund and through individual syndication deals. A syndication is generally structured as an LLC, which is a pass-through. But in addition to passing through the income, it also passes through the losses. And those losses include losses that are really purely paper losses, such as depreciation, which is one of the most powerful tools. And I'll add that these tax laws are really in favor of both passive investors, business owners, and real estate professionals. They really do not favor high earning W-2 professionals or those that have an active business. There's way more loopholes when you are actually a full-time entrepreneur or if you own a number of passive businesses. So the real reason that is the case is that passive losses, for the most part, can only offset passive income. They cannot offset W-2 or active income. Now, if you have more passive losses than you can use, you are allowed to carry them forward. So that can be a big benefit for at least growing your cash flow passively and deferring the taxes to a later point. But if you're a doctor and you invest in these strategies through real estate, it's not going to offset your ordinary income. So how it works is when you buy a building, typically like a small single family or a very small rental property, typically you would be able to take 1/27th of the value of the building and take that as a loss every single year. So for most, if you own one or two rental properties, it's usually just about enough to offset the rents from owning that property. Now, on larger buildings, which we're typically only investing in 100-unit plus multifamily buildings or larger syndications in the self-storage, mobile home park categories, we're able to do a thing called cost segregation. And that requires an engineering study. and may cost $5, $10, $12,000 in many cases. But with this study, they look through the building and look at the age of the roof, the age of the cabinets, all of the fixtures, plumbing, heating, air conditioning, and they'll assign the life of what is life that's remaining for these fixtures. And often this works out to potentially a third of the value of the improvements in the building can be accelerated. And the way the tax laws are currently, anything with less than a 15-year life through bonus depreciation can be taken in year one. So often what this leads to is when you're investing into a syndication deal that's using a traditional mortgage at 65 to 70% loan to value, it's often working out that we're getting almost 100 cents on the dollar for an investment. So in real numbers, us and many of our investors, for every 100,000 we invest, we're getting close to 100,000 loss on paper the very first year. So how does this work for an actual tax return? Let's say you have the ability to take all of the losses. If you're a real estate professional or you have other passive income, and passive income is typically shown on Schedule E of your tax return. If you had over $100,000 that is available, categorized as passive and able to be written off, and you're at the 40% tax bracket or 45% tax bracket, it really depends, but we'll use 40% as a base number, which is the top bracket federal, which is 37%, and some state income tax. If you show $100,000 less in income that year, you're saving $40,000 in taxes immediately. So if you're factoring in where to invest money, if you're worried about if there's a recession, what the stock market's going to do, or what type of return you can make on an investment, sometimes the best return you make is by what you save. And factoring that into your overall investment strategy, along with what the optimal returns are, what the whole period is. Being able to save taxes up front is something I think a lot of investors don't factor in when they're making their initial investment decisions. So in addition to real estate, there are a number of other asset classes that offer significant depreciation. ATM machine funds are an interesting niche, which could be a whole nother topic. It's kind of counterintuitive because most people think ATM machines are sort of a thing of the past, but there is a whole subset of the country that is underbanked, and with even to the extent of assistance checks are now being put onto debit cards. So a portion of the community just still relies on ATMs regularly, and there's a fund I'm involved with that has contracts with major retailers like McDonald's and Walmart that have pretty consistent use of ATM machines. And these are structured investments, but the reason I bring it up is these also do yield 100% depreciation benefit year one. And the difference between those and real estate is there's not an actual recapture because it's actual machinery, and after roughly a 7-year life cycle, they're not going to be sold at a profit. One loophole for the active earning W-2 professionals, whether you're a doctor, a lawyer, a dentist, or just own a successful business that's an active business, is oil and gas. So I've personally invested in oil and gas deals purely as a test for some of my friends and clients that have high W-2 income. And also, I wanted to test it out, even though I don't really need the tax benefits in that way. But also just given inflation and what was going on in the world, I think a few years ago oil was had a historic low, and I do think oil prices will continue to be higher than they had historically been, and that actually yields pretty strong returns as well. But oil and gas could actually offset active W-2 income. So for those that are high earning professionals, you should look into oil and gas, because that same formula I used before, where if you invest 100,000 and receive close to $100,000 paper loss through depreciation, that could actually offset your current year's income and may yield a large tax refund. If you're a W-2 and money's coming out of your check every week, the proper investment may lead to a large refund. So, I mentioned the catch, and with real estate, there is a thing called recapture. So if you take the depreciation, you're lowering your basis in the asset, often close to zero over a 3 to 5 year period. So when the property sells, you will have a recapture of that depreciation because there will be a larger gain when the property sells. Now that gain, at least the bonus depreciation, is recaptured at ordinary income. So what you've deferred maybe over 3 to 5 years eventually does need to be repaid. However, there's a few ways to offset that. Number one, you can then do a 1031 tax deferred exchange. If you sell one property and buy another property, and there are steps you need to go through to do it in a compliant way, you can defer that gain indefinitely if you convert into a new property. The other thing you could do is just the new property you buy, you also accelerate that depreciation. Now the tax laws are changing with how much you could take each, in the first year, but it will still be an ongoing strategy that can, help you minimize your tax burden. And it's something that once you start doing it, it just becomes part of your tax planning every year. Anytime you're in a project that's likely to sell, you should be planning ahead and just structuring your purchases and your sales as efficiently as possible. And that's something we work very closely with our investors to ensure that we're helping them be as optimal as possible. So that's the tax side of it. In addition to that, these are assets that have performed very, very well over the past number of years. So over the last 3 to 5 years, the average multifamily syndication deal, even through COVID, has yielded above a 20% annual return. And past results don't guarantee future results, but given where we are in the market and inflation, real estate is a great hedge against inflation. And these asset classes, just by nature of not being publicly traded and not being as accessible to probably 90% of the country, typically do perform better. Just by nature, you have to be an accredited investor for a majority of these deals, and they do perform better. And when you factor in the tax benefits on top of the returns are, in my opinion, tremendously better than just investing passively in the stock market or using kind of the traditional wealth management channels. So that's about it for this episode. Encourage everyone to please subscribe, leave us a review on iTunes or your podcast platform of choice. Subscribe and like our YouTube channel, and please email us with any questions or any topics that you'd like us to cover in the future. Thanks. Have a great day.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there, all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.